Hey guys, so welcome to this video. My name is Romeo Clark. I am a CPA and fractional CFO for ABA business owners. In today's video, I want to take the opportunity to introduce some KPIs that ABA business owners should be focusing on. Now, these are high-level KPIs that, the CEOs and the CFOs of the organization should be definitely focusing on. Now, what does KPI stand for? KPI stand for key performance indicators, right? So they help you measure how a particular piece of the business is performing, and you're now able to measure that against certain goals that are set by the industry or overall understanding of how a particular part of the business should be ran. Okay, so I want to take some time and talk about some of these KPIs because as a small business owner, the only way your business is going to get better is by you tracking these different things in your business. So, what I'm going to do, I'm going to be sharing my screen here shortly and walking you through these. So let's get started here. So let's talk about it. The first KPI or item that I would like to see on the dashboard, and it doesn't necessarily need to be the first thing, it's just one of the important things. And that is a look at your revenue and your expenses trend. Okay. What's the relationship between your total income slash revenue that the business is earning, and also what's your expenses looking like when we look at them over time? Okay, so it's important to at least look in these things within a 12-month time frame to see the fluctuation of these relationships. Why do the relationship matter so much? So your expenses are in your business to help you generate the revenue. And your expenses, as I'm going to go through some other KPIs later, further can be broken down into what's directly related to generating revenue, like your BCBA, your RBTs, your BTs, supervisors that are doing the clinical work, they're generating revenue. And then you have those that are non-billable people or administrative staff that are there really just to support the team. And then you have things that you're buying to support carrying out therapy. So we're talking about therapy supplies. We're talking about, maybe you have a physical center. So the rent, the utilities relating to that center. All right. So those are what your expenses could be broken down into. Now, the closer that expense number is to your revenue number, okay, it's going to leave a lower profit, okay, for you as the owner to operate this bit to retain in this business and also to compensate yourself. So it's important to know, what that looks like. Okay. So next thing here is where do I get this information? So your revenue and expenses will be located on your profit and loss statement in your QuickBooks file. Okay. If you have QuickBooks, if you're using QuickBooks as your accounting software, if you're using other softwares like Wave, like Xero, there are other accounting softwares out there. Usually, if you go to the reporting section of that software, you will see a P&L, all right? And usually you're able to run that P&L per month over a certain amount of months. And that's how you get the number. Right. So that's the first item that I want to highlight as number one. So I'm going to go ahead and highlight this in yellow. So the next item here is net profit. Okay. Now your net profit is your total profit when it's all said and done for your business. Okay. It's your revenue minus your expenses. We're going to be talking about some other profit numbers, but it's important to know what the total profit is, right? This number is important to evaluate because remember I was telling you the relationship between your expenses and your revenue. Whatever that distance is between your revenue and your expenses determines what your net profit number is. So it's important as a business owner to know what your goal is for the net profit and have this KPI that really shows, what this number is. So this can be found on your P&L from accounting software, okay? So net profit, right? I'll just color that in a different color, okay? So the next item here is accounts receivable, okay? Now, why is accounts receivable so important? Accounts receivable is the money that you are owed when you do services for your clients. Let's say you're doing therapy, you convert notes, and you bill the insurance. At that time, 100% of the service that you provide until you get compensated in a dollar amount is in accounts receivable, okay? Until you start getting back those EOBs, ERAs for payment, okay? And that money starts hitting your bank account, that stays in accounts receivable, okay? Now your accounts receivable are outstanding in days. So you do services today, you convert a note to bill today, okay? Each day that goes by is the days that your account receivable stays outstanding. How we like to look at this is in 30-day buckets, right? 0 to 30, 31 to 60, 61 to 90, right? 91 to 91 to 120, 120 plus, okay, days. So we look at it this way because it gives us an idea to see how things are behind with getting payments and allow us to follow up on claims. Because the truth is, if something is outstanding for a period over 30 days, a lot of the insurance contracts say, hey, we're supposed to pay you in 30 days, right? So 30 to 45 days. So if you're not getting paid in that time frame, there are things that you can do to make sure that you're getting paid. If there are denied claims, you want to make sure that you're following up on those claims and getting paid. So a CEO needs to look at this. Why? Because they're going to be able to say, oh, wow, we have a large amount of our AR in our 90-day bucket or our 0 to 30 day as a high amount. That's good. That means we're current, right? So it enables those discussion. Now, for accounts receivable, where to find? Usually the best source for this is going to be your practice management system. Okay. If you don't have a practice management system, you're looking at going to each payer portal and see what they haven't paid for, right? And finally, your accounts, your bookkeeping software will tell you that information, right? Okay, that's it for accounts receivable. And it's important to know your average days in receivables for for your services, right? So is it taking me an average of 30 days to get paid? Is it 2 weeks, right? And I know it can be different per insurance payer. So it's important just to know that. Okay. The other item here is accounts payable. Now, a lot of ABA business may not have a huge accounts payable. The biggest thing is going to be you have this piece of card, your credit card. You spend it to buy supplies and different things you need for your business, and you just pay it off at month end. So the truth is, accounts payable is what you owe in your business. So this is amount you owe, where accounts receivable was what someone owes you, right? So accounts receivable is an asset. Accounts payable is a liability. So someone owes you when you have accounts receivable, and you owe someone when you have accounts payable. So when you owe your credit card because you're spending on it, that's something you owe. So a lot of time, your credit card is your biggest accounts payable. But if you have a vendor that, let's say, for example, came to your clinic, worked on something, they sent you an invoice, right? That's accounts payable to you. All right. So we just want to make sure that for cash flow purposes, you understand what those uh, accounts payable are, because you will need to know the expectation is that you need to have some cash outflow to pay these in the future. So source of this typically, invoicing, uh, supplier invoice software. If you have a particular software that you get supplier invoices through, uh, accounting software, okay, it's a good source. Okay, uh, anywhere you're storing invoices from a supplier is a good source for this information. Uh, of course, your credit card merchant, okay, will have your credit card statement. They'll tell you when that credit card bill is due. Okay, that's accounts payable. Another uh, very important KPI to track because it helps with cash flow management. The next one here is gross margin. All right, so earlier we talked about net profit, right? But gross margin is important because it is the margin that you get for delivering services. So let's talk about this, right? You're delivering therapy services. So the margin is how much revenue do I get, and what does it take me directly to deliver that service? So what are the direct costs involved in delivering my services? Okay. So direct costs, okay, direct costs, let's break down what direct costs could be. Okay. So you have direct labor, okay, which we will categorize as BCBA, RBTs, okay, BTs, supervisors, right? Anyone you bill services under, okay, they do clinical work. Those are usually your direct people, okay? And then other direct costs could be, your clinical supplies, you know, anything necessary to carry out a unit of service that will create revenue is a direct cost. So when you look at, if let's say that, I have an RBT doing work, right? And for that hour, I make $50. Okay. I pay that RBT $25. My margin there is what, 25. All right. So it's important, 25 or 50%, right? So it's important to understand that that's the margin, if only labor was the cost. But let's say that, we had $5 worth of supplies. So now all of a sudden, we have $5 worth of supplies. That brings our cost to 30, and our margin would be 20. Okay, that's a gross margin. Okay, all right. So it's important to know that. Where do you find this source? Okay, it's usually on the P&L. Okay, and P&L stands for profit and loss statement. Okay, otherwise known as the income statement, by the way. And you get this from your accounting software. Now, the next item here is operating margin. Okay. Now, the margin here is okay. So let's go back to gross profit, right? So gross profit margin is the margin that you get from creating services. So in the case I was explaining earlier, if you had revenue of 50, let's say you only had direct costs to carry out the service 25, that's a 50% margin because we take 25 divided by the $50 in revenue. Okay, so that's gross margin. So it's usually reflected in a percentage. Okay, reflected in a percentage. And the percentage is going to be your gross profit, which would be the 25 in the scenario I explained, divided by your revenue. Okay, now we have the operating margin. Now the operating margin is, let's not just look at our direct cost, but now we're looking at overhead. Okay, so we're going to take our direct overhead to operate the business. Okay, and we're going to minus that from our revenue. Okay, let me go ahead and highlight this. Okay, so operating margin, direct costs, we're going to take our overhead, we're going to take that away from our revenue. Okay, and that gives us what we operating profit. Okay, and then we're going to take our operating profit divided into our revenue for that's our operating margin. Okay, so it's important to note that the operating margin is a percentage, and it's after you take all the costs of operating business, direct labor, and the overhead. Okay, that's important. Okay, source of this would of course be your P&L again. Okay, or income statement, and same thing. Okay, that's another important KPI. And again, the CEO and CFO is looking at this and they're tracking this over a period of time to see, how is it changing? Because we all know business fluctuates. Okay, other KPI here is utilization rate. Now, let's say you have your ABA business already and you've experienced that, hey, our margins isn't as good as they should be, right? What reflects a poor margin? What causes a poor margin in our business? Well, maybe we have people on fixed compensation, and maybe our revenue declined. Maybe we have cancellation, but we kept people on payroll. That will reduce margin, right? So how do we go back and really look at, opportunities where we could be better as a business? Is we look at utilization. And this is how much we're billing in the business versus the possibility. Now, I always look at this from a perspective of, you have this cup of water, okay? And, you have the ability to fill this cup of water to the top, but, it's not filled all the time, right? And the cup of water is the maximum capacity that you have, meaning like the whole cup is how much revenue you can really have in your business, but the water is what you actually achieve in revenue. So a lot of people will fill it up, a lot of people will fill it at half, right? So there are different fill level that each business goes. Now your goal is to fill it up, right? To get everybody utilized at the rate that based on their expectation, but sometimes it's not realistic. So we need to know what those utilization numbers are. Now it's interesting because utilization can be measured both on the client side, okay, and on the employee side. Okay, in a lot of businesses, we look on the employee side that are service-based businesses, but in ABA, both sides are factors. So I would say as CEO or CFO needs to look on both sides. Okay, let's start with employees. So your employees, they get paid, let's say they're getting paid hourly, right? And you're paying them for 100 hours of work. Okay, well, if they're a billable employee, what are you expecting them to bill off that 100 hours? Is all of it must be billable or 90% of it must be billable? It depends, and it can even depend on the role of that employee if they're billable. So a BCBA may have a different billable expectation than an RBT, right? So it's important to know that and communicate those and track them, right? So here we're going to look at what is our total payroll hours for the period and how much of that was actually billable. How much did we bill to the insurance to the client? And then those two numbers, we divide billable into payroll and get a percentage. And that is our, payable to billable there percentage. Okay. Now, there's another one for employee that we can look at is the percentage of time my employees available to how much time they're billing, right? So again, they could be, say they are available 100 hours, but they only bill 50 hours. Like, what's going on? We have more capacity. Remember, the water, the cup, the employee in this case is a cup, and we only had half of that cup filled. So why, right? So that's important. Now, client utilization, similar, client can get authorized for a certain amount of hours. We all understand ABA space that how much they get authorized for might not be the amount that they actually get services for. We want to get close to that amount, but sometimes it just doesn't work out that way. So we want to maximize that, right? So it's important to understand what's the utilization of the client. So that's, total client authorized hours versus the actual hours that are billed for that client. And we track that on an ongoing basis. All right. Okay. So that is employee and client utilization. Very important KPI to track. All right. Then we go to client retention. Okay. So it's important to note as a business that, it costs you to get a client, right? Even if it's through referral, but even can be more costly if you're spending marketing dollars to get a client, right? If you're spending marketing dollars, each client will have an acquisition cost. So it's in your best interest to do what? To maintain that client and not to lose a client. So the client retention rate is there to tell our leaders, hey, this is how we're keeping our clients. And this, we may have a particular goal, like, we don't want our percentage of client retained to drop below a certain percentage, right? We want to retain majority of our clients. So that's an important KPI. And it's as easy as we look at, how many clients did we start with? How many clients did we end with? How many clients did we add, right? And we can use that the formula to calculate our client retention rate. Okay, average revenue per client, right? So the average revenue per client is essentially a way of just measuring, how much revenue each client is bringing you on average, something you can measure over time to tell how efficient, or rather how good, well, efficient is a company is at generating more revenue for one client. So for different people, it might be different things, but this is going to be, if you take your revenue for a period, let's say for a month, divided by how many clients you have, that will give you your average revenue per client, and you can track that and see. Usually if it's getting better, that's a good thing, right? But if it's getting lower, that's not always a good thing. So just be aware of that and know how to manage that. All right. No, this was a long session, but these are some key KPIs that I want you to focus on as the CEO, as the CFO of your company. We're talking revenue and expenses trend, net profit, accounts receivable, accounts payable, gross profit margin, operating profit margin, uh, utilization rate for both employees and client retention, and average revenue per client. So, I hope this video was good for you and informative. What I want you to do is, if you're not tracking these things in your business right now, you could be missing a huge opportunity to make your business better and also to make your business work better for you, right? So if you're interested in really owning in on these KPIs and creating some dashboards that will help you, I want you to reach out to our team of, we have CPAs and CFOs on staff that can help you set up these KPIs, these source, the source of where a lot of these KPIs come from so that you can see them on an ongoing basis. So again, I appreciate your time. I'll put the link to my calendar below. You can book a time, no strings attached. We'll talk about your business, talk about your challenges, and hopefully we can find a way to help you. But that said, thank you for watching this video and can't wait to create more videos like this that will help your business, your ABA business, get to the next level that you want it to. Thank you. Take care. Bye.